Welcome, Martin, to the latest episode of Tech 10, where we talk about the macroeconomic implications on technology strategy.
Thank you, Christoph. Great to be here.
Martin, we know each other for a long time. Started that in your former role as Chief Investment Strategist at BlackRock, and I'm happy we continue this relationship now in your new role as a founder and CEO of Macroeconomic. And now I know you have so much to say about the topic we are going to talk today. I'm really curious to have this conversation with you. Today we talk about latest geopolitical risks and things that happen in our turmoil world and how these things affect technology, and in particular, how executives should decide today in these uncertain times when they think about investment in technology. I would actually like to start with the first topic that is so prominent in our minds, and that's geopolitical risks. Or what are the biggest geopolitical risks in the world that you see at the moment?
Right. I think that geopolitics have always affected macroeconomics to some extent. Right now, we have a very strong connection between the two, and hardly ever I've seen a time when, having been around for 40 years or so in this in the financial industry, the connection being so strong between the impact that geopolitics has on macroeconomics. Now, where does it affect technology most is maybe two or three things. To start with is certainly the world has become more uncertain in terms of the reliability of systems. We had a kind of an equilibrium between the West and the East. That's the first observation. On the contrary, the world has become more insecure, and that's why now these uncertainties that have now kind of erupted over the past couple of years with Russia's invasion in Ukraine, with the conflict in the Middle East going on and now kind of evolving, these kind of security questions, security and defense, I should say, questions, becoming a very important topic for how technology is moving, where the focus on technology is being moved, so where the focus of investors should also be. So where the world will need most technology progress in the future is probably in this very area. It's defense and security. So that's point number one. The second thing is probably competition for brains, that I would call it. You see in the recent past that there has been a free exchange of people sending their kids everywhere to study at the best universities in the world, and it has led to the supremacy of American universities, for example, attracting the best brains from everywhere. Because why am I saying this? This is actually the backdrop of new technology evolving. And you can actually see on the West Coast in America where the best technology at our point in time is coming from. Most of the people who founded all these companies are kids of immigrants. So it's actually the question as to whether you can send your kids everywhere to study is a question, and this is why it's becoming a question of national interest. You can see that China is now making a point of keeping their students at home, or at least repatriating them, so to say, after their studies abroad.
And Martin, do you see that as a kind of long-term trend? Is it something that's like very short-term and will go away, or is it something we have to live with for a number of years or maybe decades?
That's really hard to say, Christoph, because it's we have lived in a world for so long where we thought everything would become more open all the time, and liberties would increase, and everything would improve. Mobility would improve. People would be happy to go everywhere, and it's now retreating. And actually, deglobalization, as we're actually calling it in a kind of broader phrase, is not something that we're witnessing since Mr. Trump's first term in the office or something, but which we've been seeing much earlier already. We've roughly, as economists, we are noting the share of global trade as a share of global GDP, which is kind of the measure of globalization. And it has been going on ever since 2011. So more than, 1.5 decades actually, that globalization has come down already.
Our latest thinking in Alex Partners is that we have this vacuum, this G0, we call it. So there's no really global leadership. At least there's a vacuum where new forces enter the room that we have not seen before. From a technology perspective, for decision makers, it is so hard to take decisions. But at the same time, I think the worst thing you can do is do nothing. Unfortunately, that's what we're seeing at the moment. Everyone is like holding his horses and try to avoid making a wrong step. But making no step is also not a solution. We see, like what you mentioned before, we see disruption in supply chains where, from a technology perspective, companies should invest in creating more transparency on their supply chain with kind of supply chain control tower technology, so have more visibility what's happening, where are the parts that are moving, is there any disruption in the supply chain. You need to have visibility first before you can take any action. And then the technical solutions that you build should allow to react now that you see any disruption in the supply chain. So you need to build in flexibility so that you have the systems in place that allows you to change the route of a container or the route and also build, like, in production facilities and underlying systems that allow you to build in this flexibility. Martin, a second topic I would like to discuss with you is market protection. Recent months we have seen a lot of discussion about, for example, tariffs that were put in place, but we also see other types of market protection. This obviously is hindering or having an effect on executives taking the right decision on in that technology. How do you see market protectionism, and what kind of effects do you see in the world?
As an economist, of course, I must say that protectionism is always harmful for the global flow of trade and of capital. On a global scale, protectionism makes everybody poorer. That's a fact. So having said that, we can note that, as I was saying before, that globalization has been rolled back from 2011 onward already. This is the same happening for trade impediments, because they have risen ever since the same period of time. So we can say just the other side of the coin is that globalization has been hampered also by more and more trade impediments ever since 2010 or 2011. So that's the same kind of story. How does it change the picture if you look at technology in more detail? And one thing is very short, very clear, and I think you mentioned it before already, and that's the disruption of supply chains, because technology, and especially very innovative technologies, depend very much on the supply chains. So that's the first thing, and that's stating the obvious, basically. But also, when it comes to capital flows, and we have heard a lot of discussion, let's talk about, the big, beautiful bill and Section 899, especially kind of taking into focus the international flow of capital, which is so important when it comes to technology, especially to innovation, because you can innovate, but then if you really transform an innovation into a successful, commercially successful technology product, you need scalability. And it's all about availability of capital and flow of capital. And of course, protectionism is an impediment to that as well. So that's the two things, the stuff itself and the financing that goes with it. And the third element I would mention in this context is China, which is playing a particular role. And it's ever since we had Obama and his pivot to Asia in 2012, and the Xi Jinping coming into power at the same time in 2012, and then kind of tweaking the Communist Party in China into one particular target, and that is called Made in China 2025. So really making China the global leader in 10 selected technologies, including robotics, biochemistry, artificial intelligence, a couple of others, you name it. And roughly in 8 out of 10 of these technology industries, China is now actually leading, now that we're in the year 2025. And we need to look at that as well, because it's actually also having an impact on where investors need to look at. Now, if you think you invest in a tech company on the West Coast in the United States, let's say in the old logic, right? It's one story. The other thing is really investing in a technology leader in China, because we know that China requires a high risk premium. So it's a, you know, this is also how this change is affecting the behavior of investors probably.
And if I'm not mistaken, I think China has already more patents than the US or Europe. So they're already very innovative and no longer the the cheap production facility of the Western world. They're already very innovative with the products.
That's long gone. That kind of, you know, prolonged workbench of the world story is long gone. They're now a technology leader. They have developed their own skills. If you talk to C-level executives from German car companies, they are using the car industry like a gym. They are throwing new companies into it and they make them compete hard. And only the fittest will survive, but they will come up with the strongest innovation in car technology. Of course, this will cost a lot of money, and actually the government needs to subsidize it. But as long as they have a lot of money and their pockets are deep, they can do it, and that's what they are doing. So this is how the Chinese are achieving leadership, technological leadership in one industry after the other, which is actually quite fascinating to see. But again, if you're an investor, you really need to be aware that it's not the same thing like investing in a pretty well-organized framework, like investing in a Western country, at least up until now. Technology and the change that we have when it comes to protectionism is also the question, who is actually sitting at the stronger end, who has more bargaining power. And if you look at China's capacity in rare earths, in many other raw materials, they are really in a very, very strong position because they are sitting on something like 70 to 90% of both production and processing capacities of rare earth, which is needed in basically everything, in the production of EVs, in batteries, in robotics, everywhere, in quantum computing. So this is where we need to look at where the global kind of game is leading and who is sitting at the stronger end compared to the other.
So Martin, we talked about geopolitical risks. We talked about market protection. Let's come to topic number 3. And that's global debt. To which extent do you see the rise in global debt, both on governmental side as well as on corporate side, affects the ability of decision makers to invest in the technology that they urgently need?
That's a very good question, Christoph. I think, well, first of all, we're coming from a period where low interest rates and even in some cases negative interest rates were one of the major drivers behind technology investment because money was actually available for free basically, and it's no longer so. So competition for capital is back, and it will probably even increase. And we can see, and I would not be so worried about corporate indebtedness. Actually, corporate indebtedness on aggregate levels has come down compared to previous episodes, but where we see debt rising, putting more pressure on rate markets is actually government debt. So this is having an impact already, and of course it is also feeding through to corporate lending rates, to bank rates, etc. So basically it makes availability of capital not just scarcer, but also more expensive. And so that's definitely a negative for tech investment as well, because an investor will take a more thoughtful decision where to invest and in which technology development to invest or innovation to invest. This was not the case when money was available for free. So this is point number 1.
Do you see that cost of capital further rising, or where is the trend going?
Well, the trend is going exactly in that direction. We're seeing that major regions in the world, and if you just look at the Americas, if you look at Europe and you look at Asia, that indebtedness on the government side is rising, and as money is not flowing around the world as freely as it used to in the past, which will automatically be, supply and demand question. Supply and demand works for money as well. So the cost of money will go up. That's for sure. At the same time, that's again, the availability and cost of capital, which is per se an impediment to tech investing, to every kind of investing, to be honest. But the second thing is also a more technical question. If interest rates go up, it will make valuation of tech companies less attractive. And because most of the earnings of tech companies are way into the future, so discounting them to present levels depends on the interest rate. If you have very high interest rates, then earnings that are very far in the future will be worth a lot less at the current juncture. So this is this technical element of discounted cash flows, basically, right? So, and this, of course, if you have a lower value of your company calculated by discounted cash flows, this automatically means that you have less money on your hands when it comes to technology investing. Again, I was talking about scalability before. It's very important in this sector, basically in technology everywhere. So this is another element where I think that the global rise in interest rates is having a direct impact on tech investing.
This is a big topic that's discussed big. And what we see in our projects, with client projects, is a lot of discussion, like how to strengthening the decision making, how to insist more on ROI-based business cases and project decisions, and to put more rigor in there and a stronger governance. So, and to reduce this overinvestment in latest hype technologies, where do a little bit here in cloud topics, there in quantum computing, and AI is all over the place. So companies still cannot afford that any longer, and they need to be a lot more like cautious and decisive about where they really invest. So hence we say they need a clear technical or technology strategy, rather than distributing and spreading the money that they had before on various topics, which requires a lot of thinking, decision making, and decide on the playing fields you really want to invest in and where you want to win, and at the same time consciously decide in which other playing fields you not play in.
Exactly, Christoph. This is exactly scarcity of capital and the need for companies to become more selective. They basically need to make a very critical decision, and this is where you guys come into play.
Yes, you're right. Thank you, Martin, for this final word, because I'm afraid we need to come to an end. Thank you for being with us. It is always so exciting and inspiring to talk to you and have this conversation with you. We hope to have you back soon, and I really look forward to our next conversation. Martin, thank you very much.
Likewise, thank you so much. I enjoyed it really.